Welcome to Business Success Tips, where you learn to make more money in less time and have a lot more fun. I'm your host, Paul Sanneman. I'm founder of Contractor Staffing Source, where we help contractors build great teams. I have as my guest this morning, Michael Huffman from LYNK Capital. So the man with the money here. So Michael, tell me what you do and what LYNK Capital does.
Hey, Paul, thanks for having me, inviting me to be on here. And, LYNK Capital is a private lending company. We are a Reg D entity where we take in funds from accredited investors, and we can then turn that around and lend it out in private loans to investors, builders, and our specialty is doing value add projects. So that might include fix and flips, buy, fix and holds, also ground up construction. And then we do also offer a fairly standard DSCR product as well for where it's a no income documentation loan for people who are wanting to hold rental properties. But essentially that's what we do.
Okay, so who's your ideal client, Michael?
So our ideal client would probably range across a number of different areas. Number one would be a builder that has at least a little bit of experience. We require 3 completed ground up construction projects or 3 completed heavy rehabs as an owner of a property to do ground up construction. Or it could be a person who is a general contractor and has completed 3 ground up construction or 3 heavy rehabs as a general contractor for other either investors, other builders, but they were the GC of record on those 3 projects. Both of those experience scenarios work for us on the ground up side. We also work with investors who are employing the build to rent strategy. So with our products, you can, the takeout or the exit strategy can either be to sell as a spec home, or they can elect to do rental property takeout on that. Another ideal customer for us is a fix and flip investor, where they're buying properties at a lower price, typically off market. They're going to do some rehab on the property, and then they're either going to sell it or they're going to hold it as a rental property. And then the third type of ideal customer for us is just a rental property investor. So we offer options that's really simplify the qualification process, no tax returns. We keep it a lot more simple than going to the bank. And we do offer a 30-year fixed option. Also, we offer an interest-only option for that product as well.
Now, what kind of equity? Say you're buying properties to rent them. How much equity you need in the property to qualify for a loan like yours?
The minimum equity on a rental property, if you're going straight into a rental property that's basically rent ready now, would be 20% equity that you'd be required to put in. That's why a lot of our investors choose to do a buy, fix, and hold strategy. It's also called the BRRRR method: buy, rehab, rent, refinance, repeat. So it's so that's what the BRRRR method is. Now, the reason a lot of investors like the BRRRR method is because when you do the takeout for the primary or for your permanent financing, you're able to take advantage of the equity lift and potentially walk away from the table with reimbursement of 100% of your equity investment in the property. And if you've held the property for at least 6 months, we can give you a cash out loan based on the current as-is appraisal of the rental property.
And how tight are those appraisals? Because appraisals go over the map, right? I mean, so do you have your own appraisers? Do you use bank appraisers? How do you figure out what something's actually worth?
It really depends. For a lot of our short-term products, our bridge loan products like construction loans and fix and flip products, we have our own network of appraisers that we pull from. If we're doing a rental property loan, we'll typically use what's referred to as an appraisal management company to put an additional layer of insulation as far as appraiser independence is concerned. Because all of those loans are sold on the secondary market because they're 30-year fixed instruments where we're really geared more for the short term, but we have the capability of funding those loans. We just like to get them off the books as quickly as
It's
possible.
like a mortgage broker, you want to resell them just to get.
Absolutely. Yeah. Every 30-year mortgage, there's very few private lenders that would actually retain
Who's
those
going to
on the
hold on to
books.
something for 30 years, right? It's like a lot of money tied up for a long time.
It is. And of course, the investor profile that wants to put short-term money with us and get, say a 10% rate of return on their funds is a little bit different in, mindset versus an investor that's investing long-term in mortgage-backed securities. So it's very difficult to, how should we say, put those two types of capital together.
Right. So, could you explain to our listeners the difference in when you should use private, I'm going to call it private money versus, some capital like yours versus a bank? Because obviously the interest rates are going to vary a lot, and the equity is going to vary a lot, and the points are going to vary a lot. So maybe you could sort of, because I don't think that people listening to this, maybe you're familiar, seriously familiar as you are with how those three instruments work and when you should use them.
Oh, that's a great question, Paul. And I like to actually put them into three categories. The three categories are bank financing, and then at the other extreme would be what we would call hard money. And then in the middle of that, between is kind of where we fall. So we're a private lender. And so we do have the capability of doing projects or loans that fall into more hard money. So obviously with banks, a lot of people really like banks because they offer really competitive terms. Sometimes the challenges with banks, though, are it can take quite a while to close. Typically on a typical construction loan, it's not unusual for them to take 30, 45, maybe even 60 days to be able to be ready to close. And
Isn't there a loan to value usually higher too?
That's right. They're typically looking. They typically require a builder to put more equity skin in the game with the banks. So, for example, where we would lend up to 85% of a project, banks will lend anywhere from 75 to 80% of the total project. Very rarely would they go above that because their risk profile. So, a lot of people kind of have a misunderstanding about how banks operate. Banks operate, they can only lend money when they have sufficient capital on hand to leverage. So typically, if you're going to go to a bank, they're going to require you to provide 3 years worth of tax returns. They want to see financials. They're going to judge you as a borrower based as much on your tax returns as they are on your experience. And it's kind of unfortunate because, in this world, tax returns don't tell the full story, especially with real estate investment, because there's a lot of ins and outs and difficult, or should I say, complications with tax returns. So banks, while they do offer really good terms, so just to give you some perspective,
this is an aside to our listeners. I know a lot of guys that say, well, look I can mess with my taxes and I can do them like I want to pay as little taxes as possible and take every loophole I can. It's all legit, total legal, but it shows them don't make any money. That means they can't get a loan. So it's like, it's a frustrating because they go, do I want to qualify for a loan and pay a bunch of taxes, or do I want to take all advantage of all the tax advantages I can, but I won't be able to get a loan, right?
That's exactly why we exist. Right. That's why we say, hey, we're a private lender that's built by investors for investors, because we understand that. And here's the thing, I tell people all the time, there's also a misconception that borrowing money from a private lender is going to be a lot more expensive than borrowing from a bank. So let's just say right now, prime rate, the Wall Street Journal prime, and that's the number that a lot of banks are going to be using when you're borrowing short-term money for a construction project. So right now, that interest rate is 8.5% for most of the banks. And so then you start adding on and you say, well, banks very rarely will lend to you at prime unless maybe you're a fairly high level production builder. If you're a small guy, you're probably going to be paying prime +1, prime +2. So you're talking, anywhere from 9.5 to 10.5% on the rate. And the bank's probably going to charge you 1, if they're greedy, maybe 1.5 on the origination fee. But, so with us, we're typically going to be prime +3 So that's going to be what, around that 11% range. 10.5 is 10.99 we can do for a prime builder, for sure. So we're basically what, 2.5 points above prime right now on construction, and we're generally going to charge 1.5 to 2 points. Yeah, it's really not that much more, especially when you figure if you're waiting 60 days to close, there's an opportunity cost associated with not being able to come out of the ground on a timely basis. Our typical construction loans, if a builder comes to us with permits in hand and they've got their project really well thought out, it's generally a 2-week closing with us. So we can really get people moving forward and getting into profitability.
And what's your
sell that
ideal
property
size
faster.
of the loan? Like a $500,000, million, 3 million? What typical loan do you have on one specific project?
Well, it really ranges. So we can do loans all the way from 100,000 all the way up to 2.5 million. For an individual single property, we go up to 2 million. But if it's multiple properties, we could do 5, 6, 7 properties under one loan, and that could go up to 2.5 million on that loan. And then, of course, on the other side of the spectrum, you've got hard money loans, and I'm sure a lot of your listeners have heard of hard money. Basically, that's where if you can fog a mirror, if it's a decent project, they'll fund you, but you got to put a pretty decent amount of equity in, and the rates and the terms are going to be a lot higher on a hard money.
My thought on a hard money loan is they hope you don't pay it off because they better have the property than you pay off the loan, and they're better off financially if you fail, right?
That's right. And here again, I'm not here to criticize anybody's business model, or because it really requires there's a lot of different types of borrowers. There's a lot of borrowers in different situations. So I'm telling you, there's a lot of people that really benefit from these hard money lenders, and they do enable a lot of people to make a great deal of money. It's just as a company and as a group, we just decided that it's a different path for us. But like I said, we can get into what we would consider more to be a hard money deal. And the great thing about it is our ownership group has a great deal of experience of owning projects. We've actually developed many projects ourselves, so we understand the ins and outs. So the other reason I tell people all the time, choose your capital partner carefully, because like you just alluded to, some groups out there are lend to own operations. And if you get into a tight spot, they're going to say, hey, sorry to hear you're going through that, but here's your default notice, right? And so we've got a really strong track record of working with our borrowers to create win-win situations. I tell borrowers all the time, I'll ask them, I'll say, hey, when's the last time you had a deal just go 100% plan that didn't have any hiccups? And they'll look at you and they'll go, yeah, I can tell you understand how this business is, right? And I say, so choose your capital partner very carefully, because we are intent on creating win-win situations for our clients.
Okay. So now, what is the difference? How much more is hard money than your money usually?
Typically hard money loans, I mean, really the sky's the limit. I've seen some hard money loans where the interest rate was fairly reasonable, say 13 or 13.5% with 3 or 4 points. And then I've seen some hard money deals that were 15 to 16% interest, and they had 5 to 7% in points.
That's worse than a credit card, obviously, right?
Yeah, you're right. It's but here again, the scenario may dictate that, right? You could always have a scenario where a borrower is currently in default on their current financing and they need a bailout. And, in that case, there's really not a lot of options. So, we generally don't get involved in a lot of bailout situations unless the client is on board with us now, right? We've actually jumped in and helped people. We've injected more cash into their projects, and just put together a joint venture agreement with them to kind of offset, give us a little bit of skin or a benefit for bringing that additional capital. Right. So, we just bring a lot of experience and capabilities to bear on tough situations.
So you're sort of a capital partner. Can you give them financial advice of what's a good deal and what's not a good deal?
That's going to be tough. I tell people all the time, especially as a builder, nobody knows exactly what is going to happen when you build a property, right?
Right.
What you have to do is have a good roundtable of advisors. You have to understand what your local market needs and what it's demanding. If you look at, let's say you have an idea and you want to have a project and you say, well, I'm going to do X, Y, Z. And you look into the marketplace and nobody's sold an XYZ project in the last 3 to 6 months.
Right.
You really need to pay attention to what the marketplace is doing. So
Right.
really the marketplace is going to be the best indicator for what's a good deal.
Okay. Now, when I guess if somebody wants to get in touch with you and they're interested in finding out whether something makes sense for them, because I think, well, one more question before we go to that point. How have interest rates affected your business? And do you think they're going up or down? This is your crystal ball time, right?
Oh, here we go. Hold on a second. I've got it right here under the table. Let me grab this. Sit out here. Actually, it's my water cup. So I just looked at the water cup. Oh, that looked strange. It turned out didn't turn out good with the background. But okay, so from interest rates have definitely impacted our business, right? Go back to 2020, 2021, we were doing fix and flip loans at 7.99%. And we were making more money. We had a lot more spread even at that time than we can today. And let's just say an interest rate on a fix and flip loan is 9.99 to 10.99. So it's definitely impacted our business. We used to have a lot more profit spread built into each deal. And now everybody's feeling the crunch, right? Inflation and everything is causing the margins. So I would say that's the biggest thing to focus on, is only look at profitable deals, that are going to give you a good safety margin. Because facts are nobody knows what's getting ready to happen.
Well, yeah, do you have any, I mean, because I'm giving you my opinion, which is not worth anything, but my opinion is, I mean, we had some insane money. 3.5% is not going to happen. I mean, like, that made no sense. I mean, zero financial sense. You're literally giving money away at the price of inflation. I mean, what sense does that make, right?
It really doesn't. And understand this. I mean, the Fed's target inflation rate is around 2% per year. So an investor that's investing in 30-year fixed mortgage-backed securities or even 30-year treasuries, their idea is, hey, I at least need to make a rate of return that's going to be over and above what the anticipated inflation rate is, because if not, I'm going backward in my capital.
Right.
So with the idea that, 2% inflation is the goal, when we get down to that point, what would investors be willing to let their money go for? At that point, maybe 5% they would be. So essentially they get a net investment return of 3%. So everything about interest rates is going to key off of inflation. So if you're seeing information out there that's positive from an inflation standpoint, then long-term rates are probably going to see some downward pressure. If you see things, on the other hand, where inflation is not being held in check, then that's going to be your cue that rates may come down in the future, but it's just not yet. But let's keep this all in perspective. When I started in this business back in the 1990s, started when I was 12. When I started in the 1990s, interest rates, the best interest rate that I had to sell was around 8%.
Right.
Then as we moved through the 90s and got into the 2000s, and then we went through the first downturn that a lot of people have really experienced, and that was 2007, 2008.
Right.
In the aftermath of that, right before that, interest rates were fluctuating between 5.75%, 6%, 6.5%. So if you look at what is actually normal, I personally think that 6% to 6.5% would be considered a normalized long-term mortgage rate. So we're really not that far off from it right now. We're just, what are we, messing around with maybe the high 6%, 7% mark right now in most. So I think it's really important that everybody keeps that in perspective.
Yeah,
Now,
'cause
what's really made it difficult for people is, like you said, we went through that period of time where cheap money was just there.
I don't think it's ever going to happen again. It made no economic sense. I mean, I
No,
bought a couple houses and I got like 2.8%. I mean, that's insane, right?
yeah, I
And
bought it just the right time, and I'm at 2.75 on a 30-year fixed mortgage.
I
Go
mean,
figure.
you're not going to get rid of that anytime soon. It's like, no.
Probably not. I may turn it into a rental property before I let go of it,
Right.
before I let go of that mortgage.
But
So
I think what I'm trying to tell the listeners is don't expect that time to come back. You're going to die before it does. It's just,
that's right.
it was an
Well, and
anomaly in the universe. It's not going to happen again. If you're saying, well, as soon as you get interest rates back down to, 3.5%, I'll invest. I go, dude, that is not going to happen in your lifetime. Do you agree?
well, and think about the effect that that had on the marketplace. It caused an immediate inflation in home prices. So the number to look at is home affordability factor. So what we're waiting on now, my personal view, is that we've got to let incomes catch up so that home affordability comes back into range. Now, there's always going to be a segment in the market that's not impacted by these numbers, but I'm just talking about the largest part of our economy being the middle class and lower to median incomes. And so you just have to understand the marketplace that you're building toward, and also understand the risk. How are your buyers and your renters going to be assessing the risk of entering into some type of an agreement to purchase a home in today's environment?
Right.
I don't like to be the prognosticator of negative, but I will tell you, to look at where we are now and only see positive is probably not a viewpoint that I would recommend. I think you've got to be very cautious on every deal. And one of the things I stress, especially for less experienced borrowers, is never, nobody wants to share their profits, right?
Right.
But you need to understand that it's a very, very important factor, especially when you're starting out. Surround yourself with capital partners that augment your weaknesses and help make you better, right? So maybe you don't have a ton of experience. Find yourself a partner that has experience. Maybe you don't have a lot of capital to put into your deals, but you've got tons of construction experience. Go find you a partner that has money and is willing to join you and be a
Well, I
partner
would say,
with you.
have at least partner that's been through a couple of recessions, right?
Exactly. I mean, I could tell you a story. I helped a guy do his first ground up construction deal. Now, LYNK Capital doesn't do that, but I happen to know a couple of other places that would. And so I told this guy, I said, hey, I'll be glad to help you work through this, but I'll tell you what you need to do. I'm going to introduce you to a very, very successful builder in your marketplace, and I want you to at least have a conversation with him about partnering up. And so they ended up pulling that together. But this builder had a track record, had sold over 20 homes in the last 3 years in the exact market that he's building,
Right.
but did not appreciate the advice that he got from that partner. And I'm just going to tell you, he built a house that's too big for the current market. Guess what that house is doing right now? It's completely built, and there's very few showings. So
Right. He's now looking at, I know a lot of guys that, when they went broke because they overextended themselves. And I would say, don't build anything you can't afford to hold on to.
That's right. Well, just think about it in today's market. I mean, with his particular loan, his interest per month is about $5,500.
You probably
Let
can't
that
rent
sink in.
it. That's my guess, right?
What's that?
You probably can't rent it for that.
Oh, heavens no.
Right. So, if you just say don't build anything you're not willing to own, that's for like safe, right?
And have multiple exit strategies,
Right.
right? Put yourself into a situation where if it doesn't sell, that you have the option of putting it into rental service.
Right. That way, at least cover your butt, so to speak. Well, this is
Exactly.
interesting. So I would say, Mike, if people want to get in touch with you and learn more about this, how do they get in touch with you?
Well, they can do this. They can reach out to me. The best way is by email. You can reach me at Michael, and that's Michael at LYNK Capital. Now we spell that a little bit differently. It's LYNK capital.com. That's Michael at linkcapital.com. You can also reach me by phone. You can call me on my direct cell phone number, 980-552-1933. Once you're set up in our system, we give you access to a borrower portal, and you can submit loan requests and requests for bids on properties pretty much at will. Now, I will say, I know you've got a very broad listenership. We currently lend in 31 states. Mostly, if you draw a line from Texas, Oklahoma, Colorado, and then kind of zigzag over toward Indiana, and then head eastward from there. We pretty much cover all of those
You don't
states.
loan in California and like those states, they're called the Western states.
Right. We're not on the West Coast. We've kind of made we looked into opening there, and we really want to be able to make the commitment of opening an operations center on the West Coast when it comes time to do that. But yeah, for right now, we're not there. But I'll tell you, if somebody reaches out to me, I consider myself to be a connector. So if you've got a project, I probably know somebody that can help you out. So feel free to email me, give me a call, to even shoot me a text. Goodness, I'm whatever communication method is easiest for you. I'll be glad to get you connected with somebody that can probably give you a hand.
Okay. Thanks so much. I appreciate that. So if you need money, call Michael. All right. Thanks, Mike. I appreciate being here.
Sounds, guys. Thanks. Sounds good. Thanks.